I want to bring in Brett Ryan, senior U.S. economist at Deutsche Bank this morning. Also, Jack Caffrey, equity portfolio manager at JPMorgan Private Bank. What is the joke? What did
Nothing. No.
Did I
Jack
miss
Caffrey?
Caffrey. What did I say? Jack Caffrey.
Yeah.
You know, I was thinking of Jack Caffrey. As I was saying it, I have to say, I know
it's
Jack.
In the ballpark.
It's not that I don't know
it's
Jack.
In the ballpark. It's in the ballpark.
Maybe I don't know Jack.
It's in the ballpark.
By the way.
It's in the ballpark.
You're not the first person to call.
Nobody
Jack
at home
Caffrey.
knows. So I mean, it's just. Well, they do actually. Sorry. Anyway.
Okay. So. Help us with where you think the market is right now relative to what the Fed has now done, relative to this idea that we're still growing. Europe seems to potentially be slowing at this point, and now you're going to throw tariffs on top of all of this.
Throw tariffs on top. Okay, so let's start with the Fed. The Fed gave us a more hawkish outcome this week, dialing back the forward guidance as expected. Raising the 2018 dot. That was a toss-up between this meeting and last meeting, but they did raise their 2019 dot as well, and that could have been Chair Powell. So that we got a modestly more hawkish outcome there. The ECB started off hawkish with ending signaling the end of QE, but then went very dovish and pre-committed to a period of not raising rates through the end of summer 2019. Where does that leave us? 10-year rate is pretty much unchanged in the week, and the Bund is down about 7 basis points.
But once again, it looked like we were about to hit 3%. And
we did hit 3%. We did hit 3%.
We got dragged back down
by Europe.
But what we're hearing from Europe,
yeah.
like, wait a second, this is a global game again.
Right, and part of that pre-commitment is buying an insurance policy on the part of Draghi, given the recent events in Italy. Buying some more time there. The second quarter is not going to rebound as strongly as it is in the U.S. U.S., we're looking at 3% plus growth in the second quarter. It doesn't appear that Europe is going to be bouncing back as strongly, so they may need a little bit more time. That's why the governing council, the ECB governing council, did what it did today.
Jack, what do you do about all this? You just gave a great report of what happened this week. But what do you do?
Yeah, I think you come back to expectations, and I think expectations today, or at least in the equity market, much more reasonable than they were, say, in the middle of January. We still think you can turn good enough growth into 8-9% sort of earnings growth, and we wind up 12 months from now, probably high single digits higher.
Did you see some of the articles on 4%? They're saying we're trending in the second quarter. I saw that. I like it, but it makes me a little nervous.
JPMorgan, I think, was one of them.
Makes me a little nervous. That's hot, isn't it? I mean,
that I think speaks to why the Fed is
called a kid?
Incrementally more
negative. But also at the same time, when you've got Europe, you can only raise so fast, right? Because your real rates are going to be.
But once again, they're holding us, and their money will come in here as always goes up.
As long as it just
and you don't want
more investors in, and that brings the yield.
See the euro yesterday too. I mean, it's perfect timing. Leaving a week from today, right?
Oh,
I'm hoping for like 110.
I wonder why you were watching.
Yeah,
why are you
so happy?
Think about that. I mean, I'm just going to be like, here. Just take my dollars. We don't even need to do any exchange, really. I don't think, right? Just one for one.
One for one. You think by the end of the week?
It's hard for me not to smile about it. Huh?
Let me ask you a separate question, though. One of the things we kept hearing, frankly, for the last 6 or 8 months on the set, where analysts and investors would come in and say, actually, we think there's a bigger opportunity in Europe than we do in the United States. You heard that.
Right.
So let's do a quick sweep of markets here to date. Euro stocks are up about 1%. S&P is up about 4%. U.S. IG credit's down 4.2%. High yield credit's down 1.25%. Emerging markets down 3.25%. So I think but certainly definitely think that there's definitely more stock gains to come, and the economy is going to grow 3% plus in the U.S. at least over the next 3 quarters. However, these things are starting to diverge a little bit across markets, and it's something that people should be at least cognizant of as the Fed continues to raise rates, because the Fed is getting more confident in its rate hiking path.
Okay, what do you think? Did you hear? I don't know if you saw the Paul Tudor Jones interview earlier this week. He thinks interest rates should actually even go higher than they're going. And by the way, even if they go higher, he believes that equity markets actually melt up as a function of that.
Yeah, I mean, I can't disagree with that argument. If it's the beautiful normalization that people talk about, and that we don't have any mix-ups along the way, and that the Fed can manage a nice, gentle glide upward path.
Jack, I don't know Jack, so tell me clearly, and I apologize. It's an early morning.
Yeah, early morning. I think basically, if we sat here at the end of January, it appeared that everything was perfect. But unfortunately, I think we were priced for something closer to perfection than what we wind up seeing. Whether the politics in Europe have gotten messier, whether you're seeing growth revert back to more trend-like levels rather than enthusiastic levels that we were talking about 3 months ago, 4 months ago, 6 months ago. I think we have a world that's messier. Honestly, when all is said and done, the U.S. is maybe an island of better in that messiness, and I think that explains why you can have U.S. equities up mid-single digits. But that said, it's an integrated world.
Right.
We haven't 40% of our S&P revenues come internationally. We can't ignore what happens in Europe. We can't ignore emerging markets.
Right.
And we like to see these problems.
We haven't really touched on the
contained.
tariff issue.
Yeah.
Just to say,
Well,
is this just going to be headline noise?
So here's the situation. So $2.5 trillion in U.S. imports last year. $50 billion on tariffs on $50 billion of Chinese goods, plus another $100 billion of aluminum and steel. That works out to 6% of total U.S. imports from last year. Is that going to be a huge deal? Maybe not. The problem is retaliation. And then on top of that, when you escalate it, if the U.S. escalates, Trump has threatened to slap tariffs on autos. If we add autos into the mix, that's $360 billion more of imports.
Right.
Now we're talking about 20% of imports. That's a problem.
Okay,
So it's the escalation factor and who blinks first.
And then the question, though, is if you're running a portfolio this morning, either professionally or you have your retail investor just thinking about this, is there something you're supposed to do about it in terms of positioning yourself one way or the other? Is there a trade in this?
This second moment in time, I don't think there's an obvious trade, because I do think what we wind up coming back to is we see markets have trends, and in that regard, summer tends to be a little bit more volatile. I do think what you should be doing right now is thinking, all right, where am I going to find a dislocation? Because they seem more likely than not over the next couple of months. We've been talking about a return of volatility. It felt like we were starting to get some back. That was more or less starting to fade. As we were sitting here right before we came on set, Joe mentioned, technology company had great earnings last night, but then in their near-term guidance, we go. It's kind of what I told you it was going to be 3 months ago.
Get rid of that guidance. That'd be fix it.
Yeah.
Sure.
Doesn't mean it's not going to happen, though. That's the only difference. Right?
Well, I mean, there's guidance and there's guidance.
Right, but either if they don't tell us, but they know it, then I see that
You can't hold back.
But then you wind up having a company beat by a dime, and effectively the stock's off 4%. So you, as an investor, it behooves you
to guide to within a penny for something that's going to happen a quarter from now or a year from now.
We'd all like to think that the world is that
predictable. You can tell us what you're
predictable.
seeing. You can tell us what the trends are.
I'd like to think that I will have more ratable revenues. I'd like to think that I will have more subscriptions. And in that world, I'd like to think with better control of my costs, my margins expand.
Right.
That's guidance, is that I'm going to earn $1.76 versus $1.75. That's, shades.
Right.
Great, guys. Thanks.
Gentlemen, thank you.
Brett Baer, Jack Cassidy. Thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.